your thoughts on CPI? What do you use? What are your expectations? Well, at the end of the day, the markets are programmed around the CPI, but one of the things that is really kind of left out is actually what happens and how there's this measurement, why it's broken in the first place, but then ultimately how we end up in situations like we're in right now where liquidity continues to expand. We have this melt up. People are very hyperventilating around the CPI number. And the reality is it's not necessarily that important because at the end of the day, a lot of the other inflation that you don't see ends up in asset prices. And even though CPI might seem elevated, we're still at all-time highs on the S&P 500. As we look at futures this morning, what's the key things that we need to be paying attention to? Well, obviously, aside from the fact that we just continue to bleed higher, 63.36. Tom Lee came out and said 7,500. You know what, Tom? I'll raise you to 10,000. But the point is, we're going to get there at some point. At some point, it's just going to be very choppy along the way, and that might be the end of this decade. It's just the reality of the fact that they're going to continue to pump money into the system. The points continue to move higher. The money doesn't matter. And somebody pointed out in our chat this morning that Vanguard now is the largest owner of MicroStrategy, which tells you everything you need to know about the situation of this financial system, right? Because what Vanguard is going to do is buy up a bunch of this Bitcoin-related MicroStrategy, which is already this very leveraged product, and then they're going to lend it out to people so that they can short it. They're going to collect their fees, and they're not even going to really worry about the performance. That's the way that this whole system works. It's kind of gotten out of hand. Good morning, Eric in Northport. Hope you're doing well. All right, so we're looking at canola prices. Look, palladium continuing to rise higher, adding another 2% today. We're up to about 112 on that palladium ETF, up 12%. Since my entry on that, put 5 figures down on that one. So a lot of focus on palladium, like that long-term chart, as we have discussed. Gold and silver chopping around this morning. There's going to be a lot more action later today when we come back in on the other side. We're down on a VIX 2.8%. Bitcoin down a little bit since hitting that all-time high. The VIX down at 16.8. Yeah. Remember, the economy's doing great, everybody. Oh, wait, that doesn't matter. What matters is we continue to pump lots of money into the system. We'll talk about our checklist. We'll do our melt-up analysis. We'll dive into crypto week if it's important. And it is, because it's a good banner of where liquidity sits. And we're going to do a nice quick analysis of stocks breaking out and also look at some of those F and G stocks, because if all this money continues to flow into the system, eventually we will see some rotation into those high quality, low value stocks that continue to be ignored by the broader market. Again, if you're not up with us at 5:50 in the morning on the Pacific coast, it's too late, because once again, all the moves and all the positioning that was done this last night and the last couple of days ahead of the CPI number, that is going to be the exit at 9:30 for a lot of these positions. I do not like to play in that 9:30 to 9:45 period. I know Don does. I know some other people do. It's not what I do. I simply like to see how the positioning operated. And then from that point, 9:45 on, particularly 10 o'clock, that's where I start to get a little bit more engaged. But today, again, we'll talk about the stocks worth engaging, whether this market is safe. It's getting a little dangerous, and there's a key chart that I want to show you as to why and where smart money is positioning. As always, we bring the world down to one number: stocks breaking out, breaking down, and we are negative, -2. Right now, we are seeing a lot of strength in the top end of this market and in momentum names. That is very important. It's important because that is where crowding happens. We're seeing strength in some of the Chinese stocks. Baidu is coming into the global market with Uber. Alibaba continues to move higher, and one of my favorite stocks in the world that I trade around its 20-day moving average, Weibo, is now moving toward $10. Was back in that stock around 8, out at 48.50, back in at around 8.40, and it has been moving much higher in recent weeks. China, we're going to keep a close eye on that. But as I've said, 80% of central banks around the globe continuing to ease a lot of commitment to the global markets, a lot more froth in this system heading your way. That said, looking at the SPY, this is just chopping around. We'll be active with this today. We're hoping that we see some level of selling to start this day because I do think that the direction still remains up and to the right for this market. And as we'll discuss momentarily, the CPI figure really not telling us a whole hell of a lot that can really translate into broader market concerns. BABA popping above that 20-day, 50-day EMA, a little strength here. That MFI is a little concerning to me, but everything else is starting to look strong. Alibaba, there's movement here. There's a significant amount of upside here. So we like BABA as a potential momentum play. In addition, I talked about Weibo, all the cruise line stocks, all the strength and momentum. These stocks, it doesn't matter what their underlying fundamentals are. Momentum creates momentum in names like this. NLCH, CCL, as I've said, buying it as it breaks its 20-day moving average, selling it and shorting it when it gets under its 20-day. This is a very good proxy of broader market momentum. In addition to that, one of the proxies that we have talked about with Tesla, which we will continue to focus on today, is ARC Innovation. And I wrote about this over the weekend, and I sent this to everyone who was a member of our Tesla boot camp. ARC Innovation has significant short exposure. Looking at this right now, where is it? Short interest? Where are we? This is the problem with having a smaller computer when I am on the road. Short interest, there we go. 36 million. Woo, 36 million in short interest and rising from 28 earlier in December of last year. Why does all of this matter? Well, it matters because if the shorts have to actually cover ARC Innovation Fund, forget their valuations, forget what they actually do, forget what Cathie Wood is even managing, and forget the fact that none of the CEOs are actually buying any of their own stock. This is a pure momentum proxy for the broader market and especially a stock like Tesla. So we're seeing this strength. This has moved from roughly 45 since our momentum move back in April, all the way up to 74. Again, I am waiting for the market to roll over, but this is the type of thing that can go to 90. And then we reassess kind of what the broader system is. This is why I do what I do, is I'm looking for one or two of these events a year where you have that steep sell-off and then you see the pattern reemerge where there's lots of insider buying, where there's a lot more momentum returns to the market. And then ARC Innovation becomes a highly speculative, high upside, high beta name that provides us a lot of potential return. This has just continued to scream higher. And once again, the fundamentals are completely and totally out the window. On the other side of this, as we have said, we talked a little bit about the software companies, companies like Wix, companies like Asana. There is still weakness there. Looking at WAT, which is another name that I wasn't necessarily expecting to, be showing up on the type of weakness that we had, given the consolidation that we've had in recent months. But company got absolutely crushed, despite the fact this merger deal that came out this morning, stock down 50 from yesterday, I believe, $50, or no, $40 from yesterday. Healthcare diagnostics. Be very careful with these biotech stocks and if you're healthcare stocks. And if you're looking at healthcare, always be paying attention to the LABU and seeing if the LABU is above its 50 and 20-day moving average, and Cure, the healthcare ETF. This has been chopping around. Not a lot of strength here in the healthcare sector, but once again, all of the focus remains in that top area on tech. My watch list again, WIMI, and this thing just, I don't know why. It's just sitting here and we're waiting for a breakout. But natural stop back in here at around $3. Very high MFI, but just trying to see if we could see some consolidation and a move higher. SK Telecom over in South Korea. One of those cheaper names that we pulled from the list. Looking to see if we can get a retest back up here at around that $23, $24 level. We've seen a couple of those names from South Korea show up out of nowhere and give us a nice pop. GCT, Giga Cloud Technology, stronger momentum coming all the way back to April, but smooth, pretty simple, little bit of chop. But at the end of the day, just looking for a possibility to get back to some of these highs that we saw back in December, and it will be a slow building process. YALA, and over in China, VIPS, VIPS, VIPS share This is one of those other names. When it is above its 20-day moving average, there is exceptional upside, but just make sure that you keep a baked-in stop. You have 3 levels here protecting you here on the 20 to 50 and the 200-day EMA. On the macro side, this is a wacky story. I froze. I'm not frozen. You're frozen. Good morning from Colombia. Hey, Tim. All right. So core things at the macro level, AI chip policy continues to lift sentiment. Look, NVIDIA is the market right now. They confirmed the H20 AI chips back in China. They triggered a 4% rally. And this is going to ripple across those names like Marvel and AMD. This is one of those things where I just continue to note it's very important to take a step back and always focus on the volume weighted average price. As we've seen with NVIDIA, what is happening quite a bit, and we'll be talking about this extensively again over at our mastermind today at 2:30, is if you look at the one-day chart and you pay attention to what has happened. Yesterday, we had a sell-off to start the day. And then again, it's all about the repositioning that happens in the first 15 to 30 minutes. And NVIDIA comes down, bounces off its third standard deviation of price in the 1 minute, and just rebounds and carried on through the pretty much the end of the day, stayed above VWAP, stayed above its volume weighted average price. This is really the only opportunity to make that trade, unfortunately. But that said, keep in mind that in a couple of months, there's going to be short dated, 0-date options at least 3 times a week on names like NVIDIA, on names like Tesla, on names like Apple. And what matters about this, as we move into that newer environment, particularly in a period where volatility is probably going to pick up, and particularly in environments where, look, funds are going to take profits today. At some point, they're going to take profits. A 5% move, 4% move on NVIDIA is sizable when you're using that much leverage and you're using that much capital to follow momentum. So these types of moves, these sell-offs create new entry opportunities for other momentum strategies. And then we start to see that rebound. So you got to be very quick and you have to pay very close attention to where these opportunities emerge. And I tend to find them in that first hour of trading. And you just keep a very tight natural stop as we progress through the day. The risks for all of this remain the same. Geopolitical flashpoints can reignite export curbs. We are 1 tweet away from more chaos around trade. And again, the other thing that happens is we have other earnings reports coming up. If there is a significant amount of optimism in the regional banking space, if there is a significant amount of optimism in the oil and gas space, that can pull capital away from technology after the type of rally that we just had. So once again, pay very close attention to NVIDIA, pay very close attention to the SOXL. And the SOXL is the semiconductor bull ETF. And as we have seen, when this breaks down, it takes NVIDIA, it takes AMD, it takes Broadcom, it takes all these names with it. But just pay very close attention to this. Staying above the 20-day moving average, again, signals strong momentum, strong inflows, and this is the crowded trade, and it's likely going to continue for the foreseeable future. The June CPI release came out this morning, 2.7%, slightly above May. We have inflation again, and we're going to have this conversation for 2 weeks, and it's going to drive me nuts. But once again, I want to just highlight momentarily from now that it's not as big of a deal as we have seen, because we've seen elevated inflation going back to 2022, and the market is up 25% annually, and has now avoided a 20% downturn earlier this year and has rallied back to all-time highs in the face of inflation. So there's got to be something else driving the markets, and you already know what that is. JPMorgan reported earnings this morning, and as I have said, when it comes to earnings reports, when it comes to this month, I want you to pay very close attention to one specific trade. And there is still time to join us in the Tesla Masterclass. There is still time to dig into this today, because what I'm going to show today is not just what happened with some of these proxies like NVIDIA and ARK, but basically that if you could see everything through the lens of Tesla, you're going to see it through the lens of JPMorgan. Because as a company like JPMorgan or Wells or Goldman or any of these names reports this week, there's a very specific morning pattern that you're looking for. Because if a name like JPMorgan sees sharp profit taking, and I want to just point out, look at this chart. Look at what JPMorgan has done. This is the benefit of being JPMorgan. This is the largest bank in the world, or in the United States by assets. This company is the back door for the Federal Reserve. They are the primary broker dealer. They are the biggest beneficiary of monetary policy. And if you don't believe me, go all the way back to 2008. The stock has gone from 20 to 287. They have been handed by the Fed, deal after deal after deal that has increased their book value. And I have said repeatedly, if I can only own one company, only one stock, it's JPMorgan. And there's a reason for that, because they absorb the Cantillon effect. They absorb all of the new capital in the system, and all of that is reflected in the stock price. But after the run we have seen, don't be shocked to see this type of sell-off and then a check mark right back. It's about setting yourself up for a high probability trades, and the overreaction and the positioning of these big funds after a report, after a run like we have just witnessed. Very important to keep in mind. Citi, Wells, all on board. Citi, stronger trading offset by interest income. Asset manager CAU, assets under management growth, but there's revenue pressure. Again, I'm not asking you to follow all these fundamentals, but it is important to understand the forward guidance of banks, because that can amplify credit concerns and margin risks in the broader market. We will be paying close attention, not really at the big banking level, but at the regional banking space next week, on loan growth, on margin commentary, on forward guidance, and on regulation, because once again, there are hundreds of community banks trading for less than their tangible book value, and all of them will become M&A targets later this year and next year if we do get new deregulation in the community banking space. Okay, well, Gianni was on top of this back in May. I have been talking about this for years, the idea of this Meltup narrative. And now it is gone mainstream. Barron's is talking about it. The Financial Times is talking about it. There was an article in the New York Times over the weekend that there are dangers to a stock market meltup. No, we know. But here's the thing. Before that meltdown, we can make outstanding profits, right? Because this stuff isn't dangerous if you know what you're doing. And if you've seen this before, if you've seen speculative bubbles, and let's just point this out. This bubble is not speculative. It's not driven by, oh, I believe that NVIDIA is going to go from 100 to 200 or 200 to 50 to 3,000. That's not what is driving this. It is all being driven by the sheer amount of money that is being printed. Full stop. Full stop. Guys like Tom Lee, yeah, they set these very bullish figures, but those bullish figures are really reflected on the back of the ongoing expansion of capital in this system, which has just been doing a hockey stick for the last 15 years. So yes, it may resemble the dot-com bubble. Yes, it may be driven by PE multiple expansion. Who cares? PE doesn't matter. Price to domestic liquidity does. The amount of capital in the system, all of the money that is pumped in, all of the passive investing, hope about tariff optimism, AI hype. Guys, this is all noise. This is all noise. It's money coming in and lifting the boats. And then when the leverage has to be pulled, you will notice, by the way, that none of these articles ever mention leverage. They never mention hedge funds. They never mention margin. They never mention credit expansion. They only focus on these bull and bear sentiment nonsense. And the reality is, it's really about the sheer amount of leverage in the system that has to be unwound every single time. Yardeni's come out. He's cautioned that a meltup could be the biggest risk facing investors, even as he forecasts new record highs, suggesting it's more of a warning than a sell signal. Okay, so what do we already know? Well, we know that we have consistently, since 2020, avoided every single major market downturn. Why? Well, we already know that capital is expanding. We already know that liquidity is expanding. We've already seen this happen, and we know that it moves in cycles. But here's the important part. We have avoided it because we have taken the number of stocks breaking out versus the number of stocks breaking down. And then we have just simply gone over to our good old friend, the FNGD, and said, hey there, buddy, are you breaking above your 20 and your 50-day moving average? Because if you're breaking above the 50-day moving average, there's a problem. Because we saw that happen here in March, and we saw that happen here in April, and we saw that happen before the Nikkei crash. And we saw that happen before the money market spasm that happened last year. And we saw that happen before the bond market had that chaos back in 2023. We saw it happen with Silicon Valley Bank. We saw it happen with the gilt crisis. We saw it happen with the largest hedge fund sell-off in 15 years. We saw it clearly with COVID right here. That's it. And I wrote a piece this morning where I said, I know that people think that I'm thinking about the markets too seriously or simply, but then I took a step back and I said, everybody knows in finance, they know one hedge fund manager or one money manager who makes an ungodly amount of money, and he's dumb as a brick. It's got to be simple, because that guy who could barely add when you knew him in college somehow is managing all of this money. And now he's sitting here saying, well, we operate a market neutral platform. And then you have to explain that market neutral doesn't exist. And then he gets mad, and then he goes off to his $10 million house while you're driving a Honda Civic. The reality is that this is that simple. There is all of these funds that are returning 30, 40% a year, and everybody goes, oh God, they must be doing something really exotic. No, they're using leverage, and they're really good at getting out before everybody else does. That's it. Like, it can't be that complicated. It's math. So once again, the music will continue to dance. We will continue to dance to the music, however you want to do it. It's 6:09 here in the morning, but just pay very close attention. If our number is negative and we start to break higher, pay very close attention to what those negative stocks are, because if they are at the upper echelon of the S&P 500, that is leverage being unwound in the system, and that is signaling a potential credit issue in the financial markets. 6:09. All right. Brandon saw huge outbuying on the XLF, calls on JPMorgan. All right. So last 10 minutes. Let's talk about this real quick. As again, last thing, watch NVIDIA. It's the leading momentum indicator of this market right now. Huge gains since that April flip. Okay. Consumer price index. Oh, where do I even start with this? Okay. The consumer price index has massive flaws to it. And I keep trying to remain as calm as I possibly can about it. But basically, the CPI measures a fixed basket of various things that Americans buy, right? And the core issue with this is that it uses outdated consumption patterns and misses how people actually substitute goods when prices rise. This creates what's known as systemic biases. Substitution bias happens when consumers move to cheaper alternatives as prices rise. So beef prices go up, I buy chicken. But CPI doesn't capture that behavioral change quickly enough. So these movements on the ground, even in events of like big macro events like an avian flu, they don't capture this quick enough. So quality adjustments and what's called hedonic pricing can mask actual inflation. And a computer might cost the exact same as a different computer, but it has better specs. And that statistician will record those better specs as deflation, even if consumers pay the same amount, which is mind-boggling. Now, the second issue is the housing element. And this is one of those things where they know it's broken and everybody knows it's broken, but we don't talk about it. It uses what's known as the owner's equivalent rent. And this is a really serious problem when it comes to the fact that housing is the biggest thing, most expensive thing that people pay for, in addition to the fact that housing prices are a massive investment that is highly illiquid. And what occurs here is that CPI uses something called the owner's equivalent rent. They do that instead of using actual home prices, which creates this massive lag in the pricing of housing. So when asset prices increase, right, due to monetary expansion, due to the expansion of the credit in the system and the sheer amount of money moving around, the CPI will actually miss that wealth effect because it's focusing on rental equivalents instead of the actual ownership of the house itself, which is nuts. In addition to that, quality adjustments mask inflation. I talked about that. So like the same price products with better features get recorded as deflation, even when consumers pay the same amount. And the other thing that's important to note is that there's a timing lag. So CPI changes take 6 to 18 months to reflect actual price pressures in the economy. Now, why does all of that matter? Well, it matters because it shows you that this is not a very reliable form of tracking inflation costs. Now, I've talked a little bit about the Chapwood index, and I don't really think they're doing this anymore, but they used to. Basically, the Chapwood index was in an analysis of the true cost of living in the United States, and they would go to the 50 largest cities in the country, and they would just track the top 150 things people bought. And these were the numbers that they had. In New York, the things that people buy was up 11.6% 2024. Los Angeles 12.2. Look at some of these numbers. This is compounding annualized double-digit increases from the duration of 2017 on. It tells you everything you need to know about what people are actually paying and what the government is saying. And this is where you end up with this disconnect, because you sit here and you look at a city like New York, or you look at Chicago, or you look at LA. And I don't want to get overtly political, but I just do want to point this out because I'll be talking with Josh Brown about this in 2 weeks. The reality is you have all of this wealth trickling into this city, and the average person, the blue collar working class person, is seeing with their own eyes the increases in these prices. And you see a $29 sandwich and you say to yourself, there's something wrong with this system. And that is how you end up with a Karen Bass, a Brandon Johnson, a Mandami. It's just the way people look at the system and say, I'm not being told the truth about these finance, what's going on. Now, on top of that, the liquidity expansion, the ongoing expansion in capital in the system, which we talked about it yesterday with Michael Howell's numbers. Liquidity was expanding, yet economic activity was contracting. Well, there's something called the Cantillon effect. And this goes back to Ireland a couple centuries ago. But when new money comes into the system, and I just talked about New York and Chicago, what are in these cities? The broker-dealers. All of these big cities, you hear people say, well, these places subsidize these other places. The reality is they get the money first. And that's really important to note. So new money flows into New York, Chicago, Dallas, all of these other major hubs. They get the capital. They inflate asset prices before that money trickles down and impacts consumer goods. Then you have a leverage multiplier. We talked about T-bills. When you use short-term treasuries, that money is pristine repo collateral. That leads to more capacity to borrow more money, leverage up on treasuries, and leverage up on bank stocks. Leverage up on these very highly crowded equities. You can turn $100 million into a $2.5 billion leverage position, net 3 to 4%, gross 25 to 1 overall. if you utilize these very specific types of assets. And this collateral amplifies liquidity effects and it creates an outsized impact on equities, right? Equities go up, consumer prices go up, but the wealth multiplier, the debasement of the currency is hidden in the risk assets. It's hidden in the stock market. So you might only see inflation at 3%, but the debasement of the currency 6 to 8%, and it ends up in equities and housing and other real assets. We talk about something called bifurcated inflation. This is how asset prices inflate rapidly while consumer goods remains subdued. And I just mentioned this, right? CPI only measures what people are buying and selling. They're not focusing on equity markets. And there has been ample inflation in the stock market because of price to earnings. If you pay very close attention to that, that is a form of inflation. And the Federal Reserve wants to try to tackle it because if you look at your retirement fund and you say to yourself, well, I got a lot more money than I did a year ago, you may be willing to spend more. But they don't want to do that because if they end up impacting the equity markets, it leads to deleveraging and it leads to a lot of those funds that they rely on to own the US treasuries to unload those treasuries. And that creates friction and problems in the bond market. And then finally, you have the wealth effect distortion. Rising asset prices support consumption without showing up in CPI, right? Same thing. My house just went up $100,000 in the last year. I got $50,000 to play with. Maybe I'll buy some stocks. Maybe I'll buy a new car. Whatever it is, that distortion is one of the things that does not show up, and it doesn't seem to matter when you have a very large number of people owning, a very small number of people owning the bulk of the equity market. So that wealth multiplier at the top of the tier can lead to just more and more and more expansion of this financial markets. And everyone else is kind of at the mercy of it as a result. The overall stock market connection to this is monetary debasement flows to equities. Expanding liquidity finds its way into stocks as investors seek inflation hedges. Yes, but in addition, are chasing returns. They use a lot of leverage for the purposes of trying to squeeze out an extra 5 to 10% to beat their benchmark. CPI understates real inflation. We've talked about this. Stocks appear more expensive on traditional metrics, while real purchasing power erodes. That's the debasement. A lower reported CPI will allow the Fed to maintain loose policy longer, further inflating asset prices. And I go back and I remind a lot of people, the Fed has had to run loose monetary policy for 30 years. It is baked into major events that happened back in the 1990s. Three things: the fall of the Berlin Wall, adding billions of people to the global labor markets, China joining the World Trade Organization, joining the global trade markets, and the internet, which ultimately led us to AI. Major deflationary technology events that have ultimately led to inflation targeting, expansion of the liquidity cycle, and as a result of that, higher asset prices and higher prices in the things that matter, like housing, food, electricity, and education, all things that are subsidized by the government as well. And at the end of the day, you have this valuation disconnect. Stock prices reflect true monetary debasement, while the CPI suggests stable prices, which creates bubble conditions. And that is why we are in the environment that we have been in for the better part of 30 years. It's not going away, and it's going to continue to go until it breaks. This is just the way that I see the system continuing to evolve. And as I will argue time and time again, it is a process of boom and bust. It is a process of simply knowing where you are at any given moment in these equity markets. There is no such thing as a bull market and a bear market. There are only liquid markets and illiquid markets. And it is our job to stay out in front of that illiquidity signal, which has come back around to what we have discussed. Number of stocks breaking out, number of stocks breaking down. If that number goes negative, we turn to the FNGD and we pay very close attention to the moving averages of the S&P 500, NASDAQ, and the Russell. It is 6:20 in the morning here on the West Coast. I am going to go drink more coffee. Don is going to be up relatively soon, next 10 minutes, and I'm going to be back today at 11:30 Pacific, 2:30 Eastern to do our masterclass on Tesla. Third round, we'll be talking about proxies and volume weighted average price reversals. In addition to that, I will be in the room looking for reversion trades or some sort of breakout mechanism today on proxies and a number of other things. So if you are a member, just join us in the chat room. I will keep that open. We'll keep everything moving, and we're going to continue to try to be active if a trade emerges. I hope everybody has a great day. We'll catch up soon. Don's coming up next.